Thanks, Darren. First of all, I'd just like to make a little announcement. The patty burgers you had today at lunch were a product we're developing with one of our operators. It's called a Wave Burger, and it's a mixture of Wagyu and veal. Obviously, the attributes of the Wagyu meat product with our leanness of the veal, and that's the product. We hope to have it on the supermarket shelves close to you very soon, but watch this space for the Wave Burger. I'd also like to thank the Meyer family for sponsoring a terrific day once again. I've been to a couple of these days and they just seem to get better and better. I'd like to acknowledge the work that Rob and Lorraine and your team have put into this organisation of today's event, and it's turned out to be a cracker. You even worked out the weather, and I think you've done a great job there, Rob. I can also understand why, Rob, you were a little bit lost on some of our board meetings. I can see that you had a lot on your plate to organise here today. Ladies and gentlemen, I've been asked to look at processing for 2017, and thinking that there's only a few months left, it's going to be a very, very short talk. But I think when some of my industry contacts heard I was talking about this, they were quite interested in to work out what crystal ball I was going to use, because it is a bit of an unknown area we're running into. But they've all agreed that the next 18 months is still going to be proved to be extremely volatile for processing. My talk, I'll just cover off a few areas, and I'll first of all have a look at the industry projections, mainly through the MLA. We'll have a look at some constraints to processing. We'll look at how the industry perceives its risks, and then finally we'll just have a look at how we are trying to fit into the supply chain and the things we're trying to do to lessen the pain of the next 18 months. So first of all, I really don't want to go into too much detail. There's been a lot of commentary on industry projections over the last 6 months or so. The MLA have been very comprehensive in their information supplied to the cattle industry and the processing industry. The latest report from Ben Thomas, if you've had a chance to read it, was quite enlightening. And also, I will acknowledge the fellows down the front. I think they've gone now, but the Beef Central boys, they do a great job in putting some sort of commentary around the data that comes out. But I was involved with many of the other industry players through 2015 and 2016, looking at the fundamentals of how the projections were put together. And at that time, the drought was breaking, and no one really knew the extent of where the drought was going to end up. So there's a lot of commentary, as you could well imagine, around the cow herd retention rate, the branding rates, what sort of numbers would be flowing, looking out 18 months. I remember coming home from one of them and telling my board and Simon, our CEO, saying that we are actually in for a bad run through 2017 and 2018, because those little golden balls you try and line up in a line weren't going to happen. It was going to be an absolute disaster of a trading year for especially 2017. 2017 certainly turned out that way. It does appear from the latest data that's been brought out by MLA that processing might lift out, or the numbers coming forward for processing might lift out a little bit earlier than they first anticipated at the back end of 2018. So Ben, in his commentary just recently, said that the projections that we were looking at have been revised, and I won't go through them in much detail, but we've had a poor seasonal outlook for the winter spring, and that's been on the back of a pretty dry autumn across a lot of Australia. The old adage of the drought broke, but it didn't lose its grip, and I think that's what's been happening. We've also seen a 20-year low female slaughter rate of around 45%, and if you reflect back during the drought years when the cattle were being turned off in big numbers, we were cracking 54% cow kill. And it's that was always a concern to everybody in the industry, because that meant that excessive breeder numbers were going out of the system. We've also indicated that there's a continued restocker activity. I'll also throw in backgrounders, and just recently we've read reports where the feedlots are starting to push back on price on cattle coming out of the backgrounding system. And the demand in world price, the world market for cattle is soft and extremely volatile. Again, you've probably read and seen reports about what's happening in our global market. However, the global beef market protein market is reasonably firm, but is extremely price sensitive, and I think we're seeing that. Just recently, you've also seen reports that a lot of export product that's been chilled has been pushed on to the domestic market, and it's going to start affecting the prices that are available on the current domestic market. As the chilled product starts to run out of date, they've got to do something with it, so they're just offering it back into the domestic market. We've also seen the litmus test for meat prices. I guess the 90CL price drop about 50 cents or more in the last few weeks, down to below $6, down to about $5.90, I think it is lately, from a high during those peak periods of over $7 a kilo. And continuing on with the projections from the MLA, we see that the slaughter expectations, although initially thought to be not very strong, they've improved to about 7.6 million head, and they're basing that on the back of the decline in live export numbers. And we're seeing the adult numbers on the eastern seaboard tracking higher than year-ago levels for the first time since 2014. So that sort of indicates to us that it's starting to trend upwards, the slaughter rate. At the moment, we're killing around about 135,000 head of cattle on the eastern seaboard. That's, again, reflect back to the peak where we're in excess of 180,000 head of cattle a week. I won't go through the graph because you probably won't see it, but that's available from the MLA website, and it's just explaining our slaughter rate. Again, we'll keep on going with the projections. The cattle prices, and that's good news, I suppose, or not good news, but it's fallen below year-ago prices and is expected to remain above the 5-year average. I think just recently it's dropped below $6 and it's about $5.80, 76 or something for the Eastern Cattle Young Indicator. And out of interest, that's about 13 months since it crossed going upwards. So it's taken 13 months to correct under the $6. So what about how do those projections, how do we make of them? Well, again, it depends which crystal ball you decide to have a look at. But I guess we can see it, the herd's rebuilding, which is positive. Slaughter numbers are going to improve, again, positive. Cattle price should remain firm over the next, well, who knows how long, but certainly into the medium and medium future. So that really does mean that things are on the up, but unfortunately the processing industry still has to compete on the global market at a cost disadvantages, as Richard and Jason have pointed out earlier. So we then look at thinking about how we can move forward as a processing industry, and we start considering some of the constraints. So traditionally, processing is a high overhead and low margin business. I remember when I first got the job on the board of NCMC, a friend of mine in the red meat industry rang me up and gave me the ABC of processing. One of the things he said, John, you've got to make sure all your hooks are full, because that's the nature of the business. You've got to keep your hooks full, keep your margins there, and keep your overheads down. So at the moment, for instance, at NCMC, we're running at around maybe 4 or 5 out of 10 hooks empty at the moment. So, we're not travelling terribly well. The business is very labour intensive. I'll come to that a bit later, but traditionally, as you know, it's a very labour intensive business. There are ways to combat that, but it's pretty difficult. Processing requires a specialised skill to manage and also to operate, and also needs to be very responsive to the market signals. So it needs to be flexible as well. And I think, as Jason and Richard pointed out earlier, we do have long-term uncertainty due to the income variability. It makes things very hard to plan for. For instance, on the board at NCMC, we're trying to work out how to plan to get us through for the next 18 months, not knowing what the endpoint's going to look like. We have, processing, of course, is a very capital-intensive business. To replace our particular business, we're looking at something like $100 to $120 million. It's unfortunately, due to the age of the plants around the countryside, our R&M is high, but manageable. But I think it's good to reflect that not many new plants have been built in the last 10 or 15 years, but plenty have closed. And as you know from recent reports, we have invested about $45 million back into the plant. The board has taken a long-term view on our business. For instance, that coal store that's depicted there was just completed, but it was on the books on the board for over 12 to 13 years, and the board was not able, the previous boards weren't able to find the ability to fund such a program. But now that we've done it, it's our role then to make sure that we bring in the cost savings and the efficiencies that it allows. I'll keep on going with the constraints. I'm sorry about the size of the print here, but I think, as Jason alluded to earlier, the processing operates within the overall industry supply and demand curve. It's very hard, as Jason pointed out, to flatten that supply curve, mainly due to the fact that Australian production is mostly pasture-based production systems. So we are reliant on production systems off a variable climate. Labour, as I said, is very costly. It looks at, for instance, our plant, we're looking at between 60 and 70% of our overall cost. As I said, it's a labour-intensive business, but also because you're employing labour in Australia, we're bound by national wage expectations, not like some other countries. We heard this morning about innovation, and robotics might help play a role in offsetting the cost. I would say that would be a great thing to see. But I think more importantly and more effectively in the immediate term is to concentrate on our culture and safety within the workplace. And I'm pleased to say that we have worked very hard in those areas, and we're now able to say that our workers' compensation costs are amongst the lowest in the state. John Anderson, again, I guess I should have talked to all these guys before I spoke, but John Anderson alluded to the high cost of energy. And yes, it forms over 5% of our cost of our business. And as you can well imagine, with all the freezers and cool rooms running 24/7. So yes, we are investigating alternative energy sources and certainly trying to reduce our power usage within the plant. But interestingly, most abattoirs are in regional areas, and probably the most dominant power user in the region. So it makes sense that we should be looking at how to take these plants off the grid and use more renewable supply sources. And that solves a couple of issues, of course. It allows more reliable power to the community, and of course it's good for the business because we can start reducing one of our major costs. We have been lobbying, and we do need government support. So if you have an ear to a politician anywhere in the state, I'd encourage you to talk to them about how can we take processing plants off the grid. Again, it's been alluded to this morning, but our international competitiveness is a huge constraint. We are seeing a lot more competition from exporting countries around the world. Again, you'll see that in the press. And unfortunately, a lot of our traditional markets that we've been looking at have all been really concentrating on the price of their meat product. And I think it was John who alluded to the issue of Costco in Korea. That was basically a very price based decision. Our currency movement as well, again in the popular press, you'll see the currency is going up or tittering around the 80 cents. That's not helping at all. It puts us at a disadvantage when we're exporting. And government policy, of course, is what we term as a non-technical barrier to trade, is an enormous cost to the industry. I've forgotten the exact figure, but the total industry bears an enormous cost in our non-technical barriers to trade. Just recently I was at a meeting in Canberra with the CCA, and AMIC lobbied to have the Assistant Trade Minister responsible for this area. So hopefully we might see some reduction or some action in reducing the issues of non-technical barriers to trade. And I guess what we'd like to call the Trump effect, I don't like picking on the man, but he did make a couple of policy decisions that immediately had an immediate effect on our bottom line. And one was the move back to coal generation in the US away from the renewables. That's actually seen a drop in the palm oil price because palm oil is used in renewable energy production in the US. And because tallow is related to the price of palm oil, we've seen a dramatic drop in the price of tallow. Tallow's dropped from about $900 a tonne earlier to about $600 a tonne. Doesn't sound much, but it's about $100,000 off our bottom line per month. So government decisions impacting directly on our bottom line without any influence from us. Also, the US pulling out of the Trans-Pacific Partnership. Whether it's good or bad, I don't know, but it certainly delayed any tariff benefits that we, as an industry, were going to benefit from. So now we've got to rely on the more cumbersome and time-consuming path of free trade agreements. I must admit, we do have some very good trade agreements in place, but there are many others that we're working on, and it will take years. For instance, getting trade FTAs into Europe, they're talking 5 to 7 year time. Whoa. I've just been told to keep going. So we see issues like, again in the press, of Brazil and the US entry into China gives us also issues back home. However, we do stand as an industry together behind AMIC, and you saw on the chart from earlier from Mark that AMIC is our industry rep, and AMIC and the industry are working with government to try and tell them that we are the largest trade-exposed manufacturing industry in Australia. We're a significant employer in the state and generate significant export revenue. Okay, look, my next talk was, the next part of the session was on industry risks, but really just the headlines. This was put together by the Australian Meat Processors Council, who identified 6 risks that the industry is going to face in the medium term. And we've talked about the competition for market access. The next one was the changing consumer patterns, which you are probably well versed in. We are seeing a move away from consumers focusing on healthy and humane consumption. And although we're seen as a meat product with quality and nutrition, we're losing a lot of ground on price and resource use. Climate change, I really don't want to start a huge debate on climate change, but we do have to face the fact that climate's been very variable. That has an immediate impact on our cattle supply. The regulatory environment, again, Jason pointed out quite succinctly the problems with the industry and how we're slow to respond. And I think AMIC is pulling the meat industry together, but we do need to put together a more vertically, or pull the fragmentation vertically back in together. Another thing of regulatory compliance is our compliance in market access. We do need to have audits. For instance, it takes NCMC about 60 to 70 days a year to do all our audits. Another cost. Much like the cattle industry, the meat industry sees that they've got a social licence to operate, to overcome, and I won't go into the point 6, which was the, turn the page, which was the value chain integration, and I think Jason put it very succinctly, that we do need to move into that area. And one of the greatest benefits from that is information flowing up and down the supply chain. I'd recently attended a function in Brisbane with the Hughes family from Rangeland Quality Beef, where they were being recognised for their work with grazing and best management practice. But talking to the family, they say the best thing they were chasing the elusive dollar, which was alluded to, but they found the most important thing they found was information. They are now able to make far more meaningful on-farm decisions, and their production is now based directly to what their consumers are chasing. So finally, I guess we're looking at what's happening in the coming months. The coming months in 2017 is going to be extremely lean. There's been a number of plant closures, short-term plant closures highlighted. I think we in fact are going to look for a close down towards the end of September for a week. The cattle just aren't coming through. We do see probably an improvement a bit later in the year, but even said that, trading conditions at the end of 2017 and into 2018 are going to be extremely difficult. So we at the board, we at the NCMC are addressing these risks in terms of our cattle supply, our energy costs, and obviously our culture and safety. As well as we're identifying our production and cost efficiencies within our business, and we're driving down our break-even costs, for instance, and also driving the efficiencies from our CapEx investments. So we also started commencing value-adding at our plant, and we're encouraging our operators to look at building on their own vertical supply chain and utilising the value-adding process that we've got. So we're trying to encourage a stable supply and remove our operators away from the volatility of the livestock market. Many of our current operators who've based their business on the livestock markets have actually left us because they haven't been able to compete. And finally, we're launching 2 veal brands. I think they're on display out there into our major supermarkets. So we're looking at our own vertical integration and trying to create demand for our veal product to support our local veal members. We also hope to, in conjunction with the MLA in the spring, to have a generic veal promotion in store in the major supermarkets. And finally, I know you're tapping me on the shoulder, guys, but finally I'd just like to leave you with some thought. And when I was a bit younger, I was in the feedlot business, and Don may remember, I don't think Dougal will, but I went to a Alpha conference on the Gold Coast, and I was listening to a guru on feedlotting from the US who was going to give us an insight on how to make the most money out of feedlotting. So he gave us a rundown on obviously all the parameters you need to know, feed conversion rates, growth rates, blah, 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 nutrition. And in the end, he said, well, my secret is, and everybody went very quiet, he said, you buy them cheap, you feed them cheap, and you sell them dear. I mean, that worked for a while, but really, listening to Bill, listening to Jason, and my message to you, it's really not about that. It's about the relationships between those three sectors. And if we can build that relationship, we'll all get together and we'll move move ahead together. Thank you.
Thank you very much there, John. Is there any questions? All right, very good. Well, John, I'll just hand it over to Rob.
John, on behalf of Yugle Bar Pastoral Company, we really appreciate your input here this afternoon. I've certainly, personally, as a director of the cooperative, I've enjoyed working with you since I've been on the board, and thank you for telling the NCMC story here this afternoon.
Thank you.